Welcome back to another episode of SaaS Buyers Club. I'm your host, Omeed, and this week I am interviewing Mitch Petracca of Petracca Group. He's also the founder of an exciting new venture called FundScout. It's going to be a great conversation this week. Thanks for joining me, Mitch.
Thanks for having me. Really a pleasure to be here.
Awesome. Tell me a little bit about what you do.
Absolutely. So I've got a long and winding road, but essentially I help anyone buying and selling businesses, really with a specialty in what's called the lower middle market. Businesses from about $1 million in purchase price all the way up to 50 to 100 million is kind of the range that I generally operate in. Started my career as a CPA, very traditional accounting route. Realized quickly I was more entrepreneurial in nature and that wasn't the best fit for me. Long winding road took me to transaction advisory, where I did more upper market transactions with really large private equity firms at PwC, and later found my footing in the lower middle market, where I think it's just a really dynamic environment and there's a lot of change happening, and really wanted to facilitate a lot of that change and help people in the ecosystem.
Gotcha. So what do you focus on at Petracca Group now? You say transaction advisory. What aspect of advisory do you help people with?
Absolutely. So anything having to do with finances and accounting related to an M&A transaction, we are able to facilitate. So that includes valuations, financial due diligence or quality of earnings, other things such as modeling, and really just advisory around capital stack and other components to an M&A transaction.
Very cool. Awesome. So that's Petracca Group. And is there an industry that you primarily work with? Maybe top 3 industries or types of companies that are being acquired, anything like that you can tell us?
Absolutely. We're fairly agnostic. And really, the way I think about this is we have our core competencies and the things we're always going to do on every business. And then we have our industry focus that we've really built out in a number of industries, such as healthcare, SaaS, a lot of blue collar businesses as well, trade services, right? Construction companies and professional services, I would say, are kind of the main industries that we tend to focus in.
All the top lower middle market M&A transactions that you just named, pretty much. Those are
Exactly.
the primary areas. Yeah. I got you. And we love SaaS here because it's the SaaS Buyers Club. So
Absolutely.
yeah, so I'd love to just dive in just a little bit on, the Petracca Group work in terms of the financial advisory. What are some of the things that you're seeing in terms of what do people typically come to you for help with?
Yeah, it's a good question. And really, there's a wide range in the lower middle market because you have some private equity professionals with a lot of background who are now doing this kind of on their own outside of, the fund and traditional environment that they really started with. And then you've got other people who are Cody Sanchez disciples and the like, which is fantastic, more entrepreneurs, right? Trying to buy a business and doing the entrepreneurship through acquisition model, and they need a little more help with just the M&A process as a whole that they're less familiar with. So we really tailor our services to help educate that latter group or just help facilitate the earlier group and try to really augment and partner with their transaction however they best need it. I'd say that really what we focus on as our core competency is financial due diligence. And so that's something that's really needed on every transaction, where you need a CPA and accounting expert to really deep dive into the financial aspects of the company you're purchasing or selling to make sure that everyone is on the same page when it comes to how much money the business is actually generating. Is the accounting accurate? All these types of kind of core questions that make up the valuation of a business acquisition.
Got it. And so I hear one of the things that I heard you say is that there's a big education piece there. Is that right?
Absolutely. I mean, we really try to go beyond just giving you the report and what is the bottom line, EBITDA number that most people are really focused with. We try to really help with the process, help with the strategic aspect of negotiating, helping them think through the transaction as a whole. And if we have findings, we really like to tell them the implications and the risks of what we are seeing and how we would think about it if it was our transaction.
Gotcha. Can you give me like an idea? What's the number one thing that you find yourself often educating people about? And what does that look and sound like?
Yeah, I think networking capital is one of the most confusing things. Even experts in M&A really get confused by networking capital, and each has their way of doing it. I think really just the concept is difficult to, and it's something that we find ourselves really educating on in almost every transaction. Even if the person has a background as a CFO, they still oftentimes don't really understand, the nuances of working capital and the actual effect it can have on your purchase price. And really, that can be pretty significant in terms of the negotiations. And I'm sure you deal with this all the time, right? It's really a hand in hand conversation with legal. And it's something where you really need to be transparent and make sure that everyone's on the same page with all the advisors on both sides of the transaction, in my opinion.
Yeah, so give us a little more color from your side of things. In terms of networking capital, what are the things that you think people need to know about? What have you found yourself educating people with regard to networking capital over and over again?
Absolutely. So the number one thing is that there has to be networking capital in the business when you purchase it, right? Otherwise, it's the age old adage of you're buying a car without tires and without fuel in the tank. Really, you're buying a business based on the earnings that it will create for you in the future. But the business can't create those earnings if all of a sudden it doesn't have the networking capital on day one. So you really need to transfer all of the assets of the business to make sure that it's operating the exact same way the day after the transaction as it did the day before the transaction. And so for that to happen, you need the net working capital piece in there. And then the actual logistics of the net working capital adjustment relative to the legal and financial implications of what that means really is just the solve for how do we protect both sides relative to the changes, because you're really just trying to guess what that amount is going to be as of the date of transaction. But no one has a crystal ball. No one really knows, even the day of the transaction, exactly what the accounting is of the net working capital. So you have to go back and look at it 30, 45, 90 days after the transaction occurred to say, once the dust has settled and you've accounted for all the transactions, what actually did you receive as part of that? Where did it land based on your estimation? So that's the
Hmm.
overall kind of in a nutshell of net working capital.
And in terms of your approach to outside of the 30, 60, 90-day identification, in how do you usually advise and come up with an understanding of what that kind of true up should look like?
Absolutely. So there's a couple of ways. Again, really, the way I like to think about it from the most simplistic viewpoint is that you're trying to forecast what it's going to be. And that might look different depending on the profile of the business. So if this is a growth business, like a typical SaaS business, maybe revenue has grown 50% year over year. And so using a trailing 12 months methodology of the average over the last 12 months isn't really representative, because you're going to have more net working capital because the business has been growing, right? And so maybe a growth rate is more applicable then. In a very steady state business, right? You think of like trade services, hasn't really changed too much year to year. Usually the norm is to use some sort of an average over the last 12 months. And that's your best estimation as to what it's going to end up being, and it'll fall somewhere around there. And then there's also a seasonality component that we like to look at, right? So if this is something that's a really seasonal business, say it's something that's fully reliant on summertime, right? Then it's going to be completely different if you're acquiring this business in the winter versus the summer, where your collections and the amount of cash in the bank are going to be completely different. And so you want to make sure that you're well equipped to handle that seasonality. And it may be that you're predicting that it's going to be a little less or higher as of the date of the transaction.
I love that. I love that curated approach based on stage of the business, state of the business, approach of the business. Makes sense. I mean, I love that you chose networking capital as as one of the primary things. Okay, so continuing down the line, so networking capital is one of the primary things that you find yourself educating your clients with regard to. Makes sense. People need to know that, hey, the business that you're buying needs to have operating capital so that you can actually run and operate the business. Totally makes sense. What else are you seeing in terms of challenges in the market with respect to your clients?
Really, quality of earnings is something that needs to be done on every transaction. Usually, especially in the lower middle market, how you're valuing a business is a certain multiple of EBITDA. Probably everyone's heard of that concept, right? That you're paying 3x or 4x or whatever of the EBITDA. But when you think about the implications of what that means to the overall purchase price and how much you're paying for a business, a small change in that EBITDA number means a multiplied effect on the purchase price. So if EBITDA is $100,000 less than you thought it was, and you're paying a 5x multiple, that's an implication of $500,000 on the purchase price. And really, that's where financial due diligence often comes into play, is having support in a third party independent individual like myself to be able to verify what the true level of EBITDA is of this business in a very normalized operations only at its core. What are you going to get the first year after the transaction? And so that's something where there's so many layers to that analysis and the negotiation, and two providers are not going to give you the same answer the same way two providers aren't going to give you the same answer on evaluation. It's a little subjective. There's not definitional rules like there is for the IRS tax code or legal principles where there is kind of a guiding set of standards. That really doesn't exist when it comes to EBITDA adjustments and M&A transactions. There's generally accepted things, but really there's negotiation points, there's gray areas, there are certain banks accept certain adjustments, and there's just a lot more fluidity to the whole thing. And so really having someone like myself to help guide through the transaction is pretty essential to what ends up happening with the financial result.
Walk me through what it looks like to perform a QOE analysis. What are the steps and stages of the process? What can people expect? And what would you say? I want to also give you an opportunity to be like, okay, how do you do things versus, maybe how someone else might do things? I'm curious about
Yeah,
those.
absolutely. So like the super traditional way of doing it is you're looking at the financial statements and you're essentially looking at the trends over time, trying to spot anomalies or just things that don't really make sense to you, or just really trying to understand the business as well. And there's a lot of questions that you'll ask as a result of that, right? So I see marketing expense went up 10% in this month. Why did that occur, right? Is that something that's normal? Is that something that was an outlier? Was that a personal expense that actually doesn't have to do with the business, right? And so that's very traditional to be able to kind of just look at a high level at the financial statements. Good providers are looking at this in a very segmented approach. So they're looking at it month by month to be able to say exactly what I just kind of mentioned. Is there anything that's an outlier? And can I isolate and view that a little bit better? What we actually do at Petracca Group is we get access to the systems of the sellers, if you're the buyer, or really on either side, whoever the selling entity is. And we're looking at the very bottom level on an actual transactional basis to identify those anomalies. So we're going a level deeper. We're doing some things with AI and automations relative to finding specific keywords that may be indicative of an adjustment. So something like the word donation or contribution would immediately tell me that transaction itself doesn't really have to do with the operations of the business, isn't a real expense in your EBITDA number. And so it's just working from a more granular level and doing things with more automation to be able to comb through records effectively, because you really only have a small amount of time in a transaction to be able to look at the full financial picture and all of these accounting transactions that they spent years accumulating. And so really it's how do you get through all of that financial information as quickly as possible and find everything that you need to that's relevant to the purchase price.
What are other adjustments that people should look out for?
Yeah, I'd say donations. I think of them in 3 tiers. Let's start with like a preface of categories. So there's like the first tier. Everyone completely agrees with these things. So those are definitional interest, taxes, depreciation, amortization. That's right there in the name of EBITDA. Those everyone will be adding back to your net income. There are things like donations that are very straightforward, that doesn't have to do with the business. It just was discretionary thing that the previous owner decided to do with the business. And then there are other things that are kind of a middle tier. And I would say those are generally accepted. And maybe there's a little bit more level of proof needed to the subjectivity. And then there's a third tier that's really something that most sellers try to say is an add back, and it may be, but it's something that is going to be really difficult for a bank or an investor to get comfortable with. And so that bucket mainly includes things like travel and expenses, where if you're seeing the flight to Delta that the previous owner booked under the business, there could easily be a trip to Hawaii. It could be a trip to Chicago that they did for personal reasons, right? And they're trying to say this doesn't have to do with the business. It shouldn't be in the income of the business. But if you're looking at a flight on a plane ticket to Delta to Chicago, really hard to just prove that that wasn't to go to a conference or something else. There's just too much difficulty there. And so people don't really underwrite those things. And when I say underwrite it, I just mean they assume that it's much more difficult to prove, so they're not going to put it in that number. So really, we're doing a bulk of our work in that kind of second category of looking for things like discontinued operations that might have completely changed the profile of the business. It could be things like severance payments for a transaction an employee rather, that has since left the company. It could be legal expenses related to a one-time lawsuit that they have that hasn't happened in the previous 20 years. All these things that are very one-time, not operational. And again, really when you're thinking of it at a high level, just probably not going to be there going forward.
Real quick, I want to make a distinction. What should people know about the difference between financial due diligence and QOE? Are they the same? How should people be thinking about those things?
Yeah, I wrote a whole post on this because I actually, I'm a QOE provider. Many people would say I actually hate the term QOE, and the more so just the way it's used. And so like people think of the QOE report, and really what they mean to say is a financial diligence report, because quality of earnings is like one of the analyses that you're doing when you're looking at a company, right? Like when we're looking at a company when doing financial due diligence, we're cutting it a couple different ways to look at all the financial profiles. So quality of earnings really just means, what is that adjusted EBITDA number? That is what that analysis gets to. And it's kind of the bridge between walking through what are each of those adjustments that I just kind of outlined. And that's one analysis and one piece of what we do, but we do things like net working capital analysis. We do cash proofs to try to prove out the records. We'll often do customer concentration, vendor concentrations. We'll reconcile to tax returns. We'll do all these other things that are pretty standard in a QOE report, but really people mean to say financial due diligence report. And so that's
So
kind
they're
of
the
the
same
distinction.
thing.
Yeah.
They're
So
pretty much the same.
use
They're
that.
pretty much the same thing.
So people use them interchangeably, but like the meaning of them is different. And the reason I bring this up and the reason I even bring attention to this is because when you're a client and you're buying or selling a business, mostly buying a business, you want to make sure that you're not omitting some of those other steps that are really pretty important. And so if you're searching for a QOE provider, you don't want them to just do a QOE. You want them to also do a cash proof. And if they're missing that step, that's pretty essential to your risk profile and making sure that you're comfortable with the business. So that's really the only reason I bring it up. Otherwise, it's a nuance. Just people kind of say QOE report.
It's almost like financial DD is the umbrella and QOE kind of falls under that umbrella as a function of financial DD, if you will. It's a more focused version of financial DD. Financial DD is more encompassing, as you mentioned, like cash proof is one of the things that would fall under financial DD that may not, for example, fall into the QOE bucket.
You got it. Perfect.
Cool. Awesome. Same page. Love it. Okay, I'd love to get some game from you on the negotiation front. So what does it look like you do the financial DD? What are some of the strategies and tactics that you often find yourself advising people with respect to the negotiation piece?
Yeah, that's a great question. I think net working capital, again, is a piece that always happens as a negotiation piece somewhere between the LOI and the purchase agreement. Like it always happens where someone just wisens up and finally deciphers what that means. And there's a change in what the LOI says. And
if the LOI even says anything about working.
Exactly. A lot of times the can is just kicked down the road, right? So that's often a piece where we've now done our net working capital analysis. We've got like a really informed view of, okay, remove all the noise and those one-time transactions. What's the typical trend going to be? And how are we going to calculate this both now on like a retrospective basis and when we are in the future post-transaction closed and looking at what that true up amount is? How are we going to calculate that? And then based off that, we'll try to negotiate in a way that's more favorable to whoever our client. A buyer wants a higher net working capital number so that if the seller ends up with the lower, they'll get some money off their transaction and vice versa. So that's always a negotiation point. Ahead of kind of the LOI, I love saying, put at least a minimum EBITDA threshold in your LOI, because that way, if we do our financial diligence and we find that it's not what you expected it to be, at least there's like a really good basis and there's a good transparency, which is so important in an M&A transaction, right? It's like the relationship, the momentum, all these like soft skills. And then there's a good basis for saying, hey, we were pretty transparent with the fact that we're going to now need to change the purchase price because it wasn't what we thought it was. And so it really lays the foundation for if you need to have that conversation, you can really have a good leg to stand on and begin that conversation and just be really transparent about it. And so throughout negotiations, I always recommend be transparent, be direct, right? Justify your findings logically with math, but also acknowledge the other side, right? Put yourself in their feet, because a lot of times there's like an emotional aspect to whatever number they've gotten mentally attached to, even though that's almost never the same in the LOI as it is at the end of the day in the purchase agreement.
But I love that strategy, actually. And I want to make sure everyone out there gets this in terms of hedging, right? So that's what I heard you say is hedge the number. Hey, we think that the EBITDA is going to be this, because most of the time, a lot of the times it's not. And so when you're hedging and you're like, cool, we will pay this purchase price as long as EBITDA is this number. And then when it's not, you can go back and be like, well, we talked about this. We thought that it was going to be this number. It's not. And so let's have a conversation, because we have this understanding from the break that if it wasn't this number, then this is not going to be the purchase price. Love that. Such a good strategy.
Absolutely. Yeah. And I know there's a lot of other nuances to it, right? Like we do valuations on the front end, and then we look at other industries. We look at like a lot of comparable companies, and that's really essential too, right? Because there's two components generally of how you're making your offer. There's like the baseline number of what is that EBITDA, and then there's what am I going to multiply that EBITDA by if you're looking at that typical strategy, right, of an EBITDA multiple. There's other ways of doing it, discounted cash flow and some other methodologies that like we also look at to support our valuations. And I recommend buyers do too. But at the end of the day, most people are using that EBITDA multiple. And so you want to make sure that your multiplier is correct also, not just that the underlying denominator is correct, but also what is that multiplier and does it make sense based on the risk profile of the company, right? Like I was just looking at a company, and ahead of the time, we thought it was completely reasonable to pay a 5x multiple on this company. We actually thought that was like an unbelievable price. But then once we did the due diligence, we found out a little bit more that like, hey, they were getting all their referrals from one source, and this source isn't so reliable and it might go away. They might retire soon, right? And so that completely changes the risk profile of the business. And so even though the EBITDA number hadn't changed, the risk profile and what that multiple should be had changed. And so that's part of like the type of thing that we also try to strategize with, right? Is if we see a finding like that, we're just helping support, like, what does this mean for the risk in the business?
What did that conversation go like in terms of, did that deal go through? Obviously, you don't have to name names or anything, but did the deal go through? Like, were they able to, what did the negotiation sound like? Because it was like, okay, EBITDA was correct, but the multiple may have been a little off because customer concentration wasn't exactly where it needed to be. And so the multiple wasn't necessarily justified because there was risk there, right? Yeah, curious. I love stories on the podcast. I think stories are a really great way to exemplify and deliver really valuable principles. So is there any more that you can tell us about that deal? Or if not, that's okay too.
Yeah, absolutely. You know, basically what I'll keep it higher level. And what I'll say is like, this is the same conversation that I like to have with a lot of these like retrades, if you will, or like changes in between the LOI and when you're doing the diligence. What I like to say is find a middle ground, right? Like there's probably a good middle ground there. There's probably a different structure that you can work in to try to bridge the difference between you as the buyer and the seller. And so in this example, right, we may, let's call it like a very simple $20 million purchase price, right? The EBITDA was what we thought at 4, and it's a 5x multiple. Maybe we think now it should have been like a 4.5 multiple, right? So it should be worth like 18 million. So now you as the buyer are thinking 18 million, seller still thinking 20 million. Well, now you've got like a $2 million gap. And so how do we bridge that difference in the valuation? And my favorite two levers are like, one is an earnout. And so really you as like the buyer, you're saying, I'm happy to pay for this value like I originally was planning to. I just want to make sure that if the downside of this scenario, this risk that I didn't anticipate happens, I'm also protected, right, as the buyer. And that's a pretty fair ask, right? Ideally, that's a perfect bridge. Same with like a seller note's a great way to do it, because then they're behind financing. You can still get like the financing for the transaction. And it's those types of structures that allow you to be more comfortable offering a higher top dollar number, because it's a little more flexible and it's just more preferential to a buyer than paying all cash upfront.
Yeah. And it's like, cool. Well, I'm thinking 18, you're thinking 20. We're happy to pay you 20, but here's what we'll do. We'll pay you the 18. We'll put 2 aside for 24 months, 12 months, whatever it is. If these customers fall through, because the seller's gonna be like, no, you're fine. You're good. The referral source, solid. And it's like, all right, well, we'll put the 2 million aside and we'll see how things go. And we'll offset any losses from that 2 million. Great strategy. Love that. Yeah, we definitely see a lot of that too. And yeah, the earnout's another really great way to bridge that gap too. Very cool. Okay. Recently was meeting with a client. I'm curious how you would answer this. And the question that I got was, it sounds like you are more of a proponent of using EBITDA as the metric for the multiplier as opposed to ARR. What are your thoughts there?
ARR is a little bit more appropriate for a software company, because like a lot of them haven't quite hit their full profitability potential yet. And so the costs of a SaaS company can change drastically depending on which stage of growth you're in, right? And so it's like, I've also done raises for SaaS companies. Those are based purely on theoretical future numbers, right?
Mm-hmm.
And then usually when you're talking M&A, usually they're like close to profitability or just profitable. Maybe they're fully mature at this point, in which case I would do a more traditional M&A model. But like if you're a SaaS company and you're just pouring money into marketing, that's not representative of the business that you're buying in the future, because you might have made only $50,000, right, EBITDA on a $20 million ARR. And that's not really representative of the company, because really it's in growth mode, right? They've been trying to grow the company. And so you have to underwrite that future cash flow piece a little bit more. And so you do want to change the valuation method to really fit the company the same way if you're having that net working capital discussion, and you have to do it to fit the profile of the company. And so part of that is looking at comparables. You want to look at comparables of your industry. And I think software is a very unique one for that reason, because the software landscape changes so rapidly and more people are willing to value based off that ARR number for good reason. Like it just makes a lot of sense in a software company.
Simple. It's like, here's how much revenue you made. Let's just apply a multiplier to that. So, but what I'm hearing you say, to also clarify, depends on stage. Earlier stage, growth stage, ARR makes sense because they haven't fully realized potential. And so the EBITDA might not be there yet for them. It just makes more sense to use ARR as a simple valuation method and model. Whereas later stage, where they've hit that profitability, the EBITDA may make more sense in that regard because they've realized that potential. And so that number is actually a solid number to utilize as the revenue, as the multiplier.
Exactly. Yeah.
Okay.
And I look at it a couple of different ways, right? Like same with when we're doing financial diligence. You don't want to just be stuck to one methodology. You want to look at it a couple of different ways and see, am I getting to the same answer with each of these different methodologies, right? If I look at a comparable company, if I do a multiple of ARR, if I'm doing a multiple of revenue, whatever it may be, that's the various ways of looking at it. Just make sure they line up and that they're all pretty comparable.
And then there's no discussion of M&A, especially SaaS M&A, that's complete without touching on the multiplier. Now, we've identified the kind of thought process with which number to apply the multiplier to. let's talk a little bit about how to come up with what that multiplier should be. What's the thought process there?
Yeah, so really there, I'm going very deep into comparable companies and trying to look at what else has happened. Now, we're in kind of a
And when you
difficult,
look at
yeah.
comparables, where are you sourcing that data from?
The secret there is a place called BizMiner. They have some of the best data out there. There's some other
Secret.
places. Yeah. I'll give you a couple on this. I'll drop little nuggets here and there. But there's like a lot of people who use Cap IQ and some other places. The problem is like if you're looking at a public company or you're looking at a much, much larger company, that's not really a true comparable to like a private SaaS company. And so you really want to make sure that you're using comparables that make sense. And so BizMinder is really great for that private company. I do something more like Cap IQ for a larger public company. And so again, you got to match it to the profile of the business. That's pretty essential. And then I'd really be trying to use NICS codes, they're called, right? To drill down below the level that's just broadly software. And am I looking at property management software and what have those sold for? And then I'm also thinking of when I find those transactions, what were the dates of those transactions? We're in a difficult time for multiples because what multiples we were seeing in 2021 are completely different from what we're seeing just 3 years down the road because interest rates are completely different. And so multiples are a lot lower than they previously were, right? You could justify a much higher price because you could get much cheaper debt in the past. So you have to handicap that a little bit as well if you're finding an older transaction that you're comparing to. So it's just really like a blend of all these considerations to try to get you to, can I find something that was pretty similar in the profile of the business as best I can? Again, looking at it from different angles, looking at the risk profile of the business, looking at how solid do I think the business is in its footprint, right, and in its niche, and how replaceable is it? I think it's like pretty important within SaaS because things, again, change very quickly. There could be a high growth SaaS company, and then there could be one that's just completely entrenched. It is the niche solution, right? That's probably not going anywhere for the next 10 years.
And what are the typical multiples that you're seeing on like a 2 million to 10 million ARR business?
Yeah, that's a good question. And really, I don't want to give a cop out, but SaaS is probably the biggest range of multiples that you'll see. Very like typical multiples on a business of that size would probably be on the low end, like 3, probably 4. You wouldn't really see 3 very often in software, unless it's like a flash in the pan. And then really it'd be like 4 up to, you can see 10, 12x, right? Like I've seen software companies that are 3 years old, right, that don't have very much ARR, but their growth has just been explosive. And there's a clear need in the market, right? They've demonstrated that product market fit, and they're clearly on their way up, right, in a kind of a parabolic shape. So it's really dependent on the profile of the business. And again, it's like SaaS is one of the hardest to ultimately come up with a price for because there's so many factors and just a range. Now, like there's a really good marketplace specifically for SaaS, which is the opposite side of this conversation. Like you have more data points because there are more SaaS businesses changing hands. And so acquire.com sells a ton of them. And it's a very comparable landscape because they're all doing it the same way. And so you can just like as a cheat code, also look at acquire.com and try to find a similar type business and see what that went for. You won't roll out the specifics of like the risk profile, but you can get a good sense.
Awesome. Yeah, I think, and everyone obviously always like on sell side thinks that the multiplier should be, the multiple should be like much higher than the buyer often thinks it is. All the sellers often really are gunning for that 10x multiplier. Oftentimes that's one of the biggest complaints that I hear from buyers is unreasonable multiples from sellers. Do you see that too?
Absolutely. I mean, it's the sell side's job to come up with a higher multiple that makes sense, right? It's the same.
Yeah.
You're going to meet somewhere in the middle, but you want to make sure that they have realistic expectations and so that they're not so far off that you're just going to be wasting your time with the transaction. So I like to be really firm in the LOI stages and like not bending too much. I like to give my best offer right away when I buy businesses myself.
I think that's a great strategy. It's like, let's not beat around the bush and let's just get right to it. Can we see eye to eye here? If not, let's not waste each other's time.
Yeah, exactly. We could like tweak a couple things relative to the structure that might get you a little bit more like we talked about earlier. But generally, I'm going to like stick to my valuation and what I've done to back it up.
I want to transition the conversation now to talk about this venture that you're working on, this FundScout. Tell me a little bit about what it is. How did you come up with the idea? I would love to hear about it.
Absolutely. So I've actually spent some time as an independent sponsor myself. And for those who aren't familiar with that model, it's like a private equity firm, but basically you don't have a fund. And so the idea is like a single person trying to buy a business, and then you put together the pieces of the capital behind it to buy the business. And then you go in and more of an advisor capacity. You're not quite doing the entrepreneurship through acquisition model where you become the full-time operator, but rather you set up a team, right? Very similar to what private equity would do with a
What business did
transaction.
you buy?
So we actually bought a manufacturing company, Omeed Group, and we made around it a couple others as well. And so like, it's just, again, I've always had that entrepreneurial spin. I think there's fantastic upside for those doing this model. Really.
How long ago did you buy it?
Yeah. So that one was in December. So still pretty fresh.
Okay, cool. Congrats.
Appreciate it. Appreciate it. Yeah. That was
Cool.
a year in the making, as those journeys tend to be. And really like, FundScout came from a need and a friction point that I saw through that process. And just, I see so many of my clients and just people in M&A are really dealing with, which is if you don't have those relationships, or maybe you came from private equity and your relationships only at the large scale banks, right? Big transactions, it's really difficult to find capital to put together and get a transaction done. It's one of the biggest friction and risk points of a transaction. So you probably see this all the time, right? Deals break because a bank has changed their terms, or last second they were going to underwrite the deal and they don't, or they all of a sudden
Funder doesn't come through, like investor falls
who
through.
knows? Exactly. So it happens all the time. Probably the biggest risk point for is your deal going to go through or not. And then on top of that, it's just incredibly time consuming. You have to do so many emails. You have to pick up the phone. You have to somehow figure out who to call for your specific transaction, who the right fits are. It's really arduous and time consuming, really difficult to know who's where in your process. Have they signed the NDA? Are they in the data room? When did I last talk to them? Did I follow up on them? So just this huge friction point that we saw. And my co-founder is a 3-time entrepreneur with 3 exits, and essentially started a family office and was going to do the same model. And he and I were tag teaming, right, going through, and really he came at the private equity world a lot from a really different standpoint, which was really eye-opening for me specifically. And this was almost like an outreach marketing problem, right? You have to get volume through to be able to source term sheets, and you need to create like a structured process. And so he and I together developed like this methodology that is for mass outreach with deals. And so that has further been refined into FundScout that we're just starting to launch now. And really what that is a mass outreach platform and service where we are really from a white glove perspective, finding debt and equity for deals. And we do everything from the beginning to term sheets so that you have multiple offers. Now, really that flips the script of what we were talking about, because ideally now you have 3, 5, 6, 7 term sheets from banks that, if someone tries to change on you, or, you're trying to get better economics, you can negotiate with them. Right now, you're coming from a place of power where you have more leverage over the banks, and you've really found a bunch of people who want to put money into this transaction that you found that's really fantastic and works from a profile. And so we've also aligned this company such that there's no risk for whoever's using it. So really that's a big part of this as well, is that an investment bank is a very different approach where they're a consulting company that also takes a percentage fee at the end, right? And so we didn't want to take retainers because there are so many people who, if a dead deal happens or just whatever might end up happening between the phases of the deal, we didn't want to align ourselves that same way. And so we're taking no retainer fees. We're eating technology costs, labor hours, pretty drastic, amounts, just to only get money if the deal is funded. And really, when you have multiple term sheets, you're able to source such better economics that our fee pays for itself. And so we've set up this ideal win-win-win situation where now you don't even have to deal with the debt and equity. We're going to source all the term sheets for you. But the counter side of that is it's a very exclusive service because we are aligned with you as direct partners. We have to believe in the deal and its ability to get done as well. So a little bit more about kind of how this service works. Really, it's mass outreach using hyper-personalization. We've sourced 209,000 different investors and lenders. And so we're hyper targeting and matching really directly to each deal. So what industries, what criteria, what sizes, what geographies does this bank lend in? And then we match that directly to the profile of your deal. And then we basically have automated systems to follow up whenever someone may have dropped off, to push them through the NDA, to get to the data room, to get them on the call, and just to make sure that we're doing this process as efficiently as possible.
This is a live service. Currently, people can use it.
We just launched and it's been fantastic so far. Like, I wouldn't imagine raising capital any other way after doing it this way.
Yeah, raising capital really suck in terms of the outreach process. Like, that's the worst part of the process.
It's not fun, really boring. Like, it's much better if you just spend your time doing the due diligence, really adding value to the transaction. If you're down the road, really you have a lot of operations with your portfolio companies you have to worry about. There's just better uses of your time, really.
Yeah, people see it as a grind, and oftentimes they don't even know where to start. So it's like, and cold outreach is the worst. So you're sending hundreds, thousands of emails, not hearing back from people. What is the process of getting on? So I hear it's exclusive. Tell me a little bit about that. What do people need to know about getting on the platform?
Yeah, absolutely. So really, we want to make sure that we believe in the deal and that it can get done, because ultimately our service is only as successful as the deal that's being put through it. Because really, we're going to match it with the right lenders, and we're going to widely distribute it across the market such that if there's investors out there that are going to do this deal, they'll find it and they'll invest in it. And so really, if the deal doesn't work for any investor, our service can't help you. And so we don't want to be at risk for those types of transactions. So part of it is that we're focusing above the SBA level. So our minimum is $5 million. There's already great solutions out there for those going below 5 million. The SBA is pretty similar across the various banks, and they have requirements. But then there's a lot more flexibility and variability above the $5 million level. So we're really facilitating a lot of independent sponsors, fundless people, direct companies that are doing, slightly larger transactions. So that would be kind of the first piece. And then secondly, we just want to make sure that you have a signed agreement before we're starting, of course. We're looking at, does the structure of the deal, does the multiple make sense? We're pretty confident it's going to get funded. Obviously, we have a lot of data points at this point. And we're just generally making sure that it's a good fit for both of us, essentially.
Gotcha. When you say signed agreement, do you mean LOI or purchase agreement?
LOI. We like to have you be a little bit through the diligence process too, because deals, as you know, die very frequently within the first 2 or 3 weeks after LOI, when you really would have seen something in kind of that like red flag stage of diligence.
Got it. Yep, totally makes sense. And what are your transaction fees for helping to make the connection look like?
Yeah, absolutely. So it's a tiered, fee. It's roughly 3.5% on the debt side. It's a little more expensive on the equity side at about 6%, because that's really a lot of people taking. You have to match multiple people to the equity side, which is a lot, more difficult of a process. And really, again, that's fully only on commitment. And so really, we're going to, save you at least that much. And we're going to take the process completely off the table for you. And really what we try to do is just keep that really in line with investment bankers and their success fees. But we're also, again, not taking anything on the front end, and really, for my opinion, offering a better service.
Yeah, that's a fantastic deal, because there's so many. I know of other similar services, but they'll charge you some fee up front, no guarantee of actually connecting you to capital. Love that kind of success fee model, obviously with the more stringent requirements up front to know that if you qualify, you're likely going to get funded, but if you don't, you're still not going to have to pay anything. Great model. Cool. Mitch, thank you so much for joining this week. Really appreciate you coming on the show and all the game that you had to drop for people out there. So much more we could have talked about, but just really appreciative of your time. Is there anything that you want to share with the audience out there? Last thoughts, comments, opinions, final tips, anything like that?
Yeah, absolutely. I would just say really meet as many people in this space as you can. Part of the reason I love this ecosystem is people within the smaller M&A space really just love helping each other, and they love talking about it like we have today. So in the same way, if you have a transaction, you want some help, happy to refer people too, right? I think that's a big piece of it too, is that us us as advisors, we also just want to make your transaction successful. And that's really what it comes down to for me, is just facilitating the whole ecosystem. I think there's a lot of, it's not really competition. It's more friendly supporting each other, which I love about the space. So please don't hesitate to reach out to me, anyone who might have a transaction or just wants, an introduction or really just an insight in general. So you can find me on LinkedIn, of course, FundScout.ai or PetraccaGroup.com.
And all his contact information will be in the show notes below as well, so you'll be able to find him like that. Again, Mitch, thank you for joining me this week. And for everyone out there, this was another episode of SaaS Buyers Club. Thanks for joining this week. As always, make sure you follow, subscribe, like, comment, use the emails. Send me an email. Tell me what you got from this episode. What are your takeaways? What did you find most helpful? What do you wish that I asked that I didn't ask? What questions would you like to see from other guests? What other guests would you like to see? Just say hi. Whatever. Tell me that you hate me. Whatever it is, I don't care. Just reach out. I want to hear from people. I love connecting with the audience. And so, yeah, for everyone who's listening, thanks for sticking around all the way to the end. If you're still here, you're awesome. And I'll see you next week.